The following script was written, verified, and approved by compliance professionals at financial regulation courses. The Trust Indenture Act of 1939 is a core piece of federal legislation designed to protect debt investors. Enacted as a 1933 amendment, it bridges a gap by requiring a formal trust indenture for corporate debt. Issuers must appoint an independent institutional trustee before offering non-exempt debt securities for public sale. The TIA ensures bondholders' rights are actively protected through strict statutory protective covenants and independent oversight. The Act uses explicit dollar volume thresholds and asset classifications to isolate specific segments of capital markets. A qualified indenture is mandatory for non-exempt corporate debt exceeding $50 million in any 12-month period. Issues under $10 million are exempt, while those between $10 and $50 million have streamlined registration requirements. This threshold includes the total aggregate principal of all debt securities issued by the same obligor within 12 months. The TIA primarily encompasses corporate bonds, notes, debentures, and equipment trust certificates issued to the public. Large sectors like U.S. Treasuries and municipal debt are explicitly exempt, which is a frequent exam point. Treasuries are exempt due to government backing, while municipal entities are excluded under Section 3-2. Short-term commercial paper and private placements to accredited investors are also exempt from the Act's purview. Pillar 1 is the indenture document itself, the legal contract disclosing all financial particulars and protective covenants. Positive covenants require the issuer to perform duties like submitting audited financials and maintaining insurance on assets. Negative covenants restrict corporate actions, such as taking on excess leverage or selling assets without trustee consent. Pillar 2 mandates an independent institutional trustee, which must be a U.S. corporation with substantial capital. To ensure independence, the trustee cannot hold more than 5% of the issuer's voting stock. Pillar 3 covers communication. The trustee must maintain investor rosters and provide comprehensive annual reporting disclosures. Prior to default, the trustee's duties are strictly ministerial, focusing on scheduling interest distributions and basic accounting. Upon a default, the role shifts to an active fiduciary duty under the federal prudent man standard. Under Section 315C, the trustee must exercise the same care a prudent individual would for their affairs. This includes the right to seize collateral and notifying all bondholders of any default within 90 days. Section 316B serves as a Bill of Rights, preventing majorities from reducing principal without individual consent. This protection stops concentrated creditors from collaborating with issuers to wipe out minority bondholders during private restructurings. For exams, remember, the TIA applies only to corporate debt exceeding $50 million within 12 months. Trustee duties are ministerial until a default occurs, then immediately shift to the rigorous prudent man standard. The SEC verifies trustee eligibility via Form T1, but does not endorse the debt's investment quality. Visit financialregulationcourses.com for premium preparation tools and resources for your finance career. Thank you for joining us for this institutional review of the Trust Indenture Act of 1939.